Joining us now is Andrew Graham, Managing Partner at Jackson Square Capital. Andrew, great to have you at the desk.
Great to be here. Thanks for having me.
So stocks are rebounding after yesterday's sell-off. We see oil prices moving in the opposite direction. They're coming down. Do you think this rebound is justified, or is the market still underestimating the geopolitical risk that's out there?
That's a really hard call for me. I mean, the geopolitical risk stuff usually put in the sort of lower on the risk list. And yeah, I mean, if you have higher oil prices, you're going to have higher headline inflation. You're going to have higher bond yields. That'll be a drag on risk assets. So it's something to keep an eye on. But ultimately, I think the consensus view, and I don't have any reason to disagree with that, is that eventually they'll come to terms and the fighting will stop, and you can move oil through the Strait of Hormuz, back to 60% of full or something like that, which is what it was last week.
So this escalation that we've seen between the U.S. and Iran is not making you any more cautious on this market?
No, we had this big drawdown in tech names, and that's sort of where I'm most comfortable. And I think this is the opportunity to reload, to add exposure to your highest conviction stocks after a 20% pullback in a lot of them. So that's our opinion.
Yeah, it's interesting because when you were last on in February, you said that big tech was going to take a pit stop. Mm-hmm. So that's still sort of the case. And do you think that big tech will continue to lead?
So big tech, when we're defining it as hyperscalers, I'll just kind of narrow it down a little bit. So let's call it Google, Amazon, Microsoft, and Meta. Do I think the pit stop is over? I think so. Yeah, it's time to kind of put up or shut up when it turns, when it comes to return on invested capital. And I think they have the ability to do that now. You have token costs that have been going down, consistently falling. And then you have token prices, which is what they're selling the compute for, that have been consistent and have been just pretty steady. So that margin there is what I think what's going to give them the ability to put up higher revenue numbers, and I think incremental margins are also biased higher.
You'd be a buyer of all of those right now? Because we've had other guests come on this week actually alone saying either trim profits in the Mag 7 or avoid them altogether.
No, I think it's too late for that. And I'd buy Google and Amazon. Those are our two favorite names there. So I think the gap, between the performance gap between the hyperscalers, which have underperformed, and semis is going to close. But rather than most people who say they're going to cut CapEx guidance for 2027, that's going to cause the hyperscalers to go up and the semis to crack. And I think that was part of the story as well. Initially, this sell-off that started with semiconductors started in South Korea. You're talking about all the leverage. It was a very, very crowded trade. So what we're doing is unwinding that now. And in the background is this other story like, hey, what if these one or two, whatever, guide or at least get the messaging, a little softer messaging on CapEx. I don't see that at all. I expect CapEx guidance to be biased higher as well, but I think you can still bring that performance gap together by putting up a better return on invested capital. They did it in Q1. I think they're going to be able to do it again here. And
so this market that seems a bit shaky and concerned that we'll start to see this cut in CapEx down the road. Do you think that's wrong?
No, eventually they will start to trim CapEx. It won't grow at this rate, exponentially. So eventually you're going to get there. And I think what's going to happen though is you're going to have the revenues improve. You're going to have the incremental margins improve for the hyperscalers, and that's enough. That's all we want to see is that it's working, and then you don't have to. You can cut it a little bit later. It's not going to hurt the semis at that point.
We've seen memory stocks, which have been some of the year's biggest winners, really start to pull back. Obviously, not necessarily the case today. Do you look at that as a buying opportunity?
Well, these memory stocks, the commodity business, right? Commodity and prices solve themselves eventually, right? You've got not enough supply, you've got a lot of demand, and that'll come into balance. Probably not until you see meaningful capacity in 2028, before things kind of reach some sort of stasis in terms of supply and demand. But yeah, that's not on our list of things that we're buying and that we're adding at the moment. They have moved a great deal. They've all moved, the disk drive guys and Seagate and Western Dig and Micron and so forth, they've just had the run, and you got to worry about at some point. Again, it is a commodity, and the party's gonna stop. And so if we are going to do it,
you're saying 2028. That still seems like a lot of runway, no?
We own those names, and we have large embedded gains. So I don't necessarily think we're going to need to add more. For this pullback, we're using it as an opportunity to add exposure to the networking equipment stocks, the optical transceiver stocks, so Lumentum, Coherent, and then we'd probably get a little bit more pullback here on some of the cybersecurity names. So the whole idea that these Chinese open source models are closing the gap with US frontier lab models, maybe 6 to 9 months behind. But if they're 6 to 9 months behind Claude Mythos, does that bring up this whole danger of vulnerability detection and so forth? And I don't see US corporates slowing their spending on cybersecurity. So Palo Alto, easy one, CrowdStrike, we own those. Those are the big platforms. And then we recently added Tenable, which is a mid-cap stock, and you can only own so much of it. But that's right in their wheelhouse, is that vulnerability identification detection.
Okay, just going back to memory for just a second, I do have to ask you. You say you're holding on to some of the names that you already have. You're not buying any on any dips. What about SK Hynix, U.S. listed shares? Will you be a buyer there?
We'll let it sit around for a while. Like we got that question on SpaceX, are you going to be a buyer on the IPO? And no, we'll just let it trade for a while. We'll let them, report a quarter or two and just kind of get the feel for it. Because like the dirty secret about, what we do at Jackson Square Capital is we do blend a little technical stuff in there as well. We just want to make sure we're not buying something at absolute high. So we're buying stocks when they're oversold, and you kind of get a sense for where they're going to settle down. That's where we're trying to add them. I see that in the networking equipment stocks I mentioned. I see that also in the hyperscalers that I mentioned. And so those we would buy now, and then we would wait on the cybersecurity names.
Okay, so you didn't buy SpaceX cheaper than the IPO
No,
yesterday.
but I'm open to it. Like I have no bias against any stock. And people would roll their eyes at Tesla because it's just a really expensive car company. But you have to stay open-minded about these things. And so there's a time and a place for everything, and we'll get to it.
Okay, we've spent a lot of time talking about tech. What about the rest of the market? Because we have seen the Russell outperform. We've seen the Dow. Although I will say the Dow and Russell are lower on the week. But what other pullbacks are you buying? Where are you putting money to work? Maybe potentially not on a pullback. That's areas of the market that are still undervalued. Yeah,
I mean, it's hard. Pharma, we have a big position in Lilly, of course, and probably about 4 months ago was Johnson & Johnson we added, but we own all those in AbbVie. They're all fine to buy in here. I think the problem that we're having is that consumer confidence was so low, reached an all-time low last month. And there's only one place for it to go, which is up. And a lot of that's driven by inflation expectations, really gasoline prices. So gasoline prices go down, consumer confidence goes up, and you probably want to own the consumer discretionary names, like just the retailers and things of that nature. Can't find many I'm really, excited to go out and own. There's the mighty Costco that you could buy. They had, numbers yesterday, and I think it's a clearing event. You can add that name. TJX is a stock that we like a lot. We've owned for a long time. I don't know if we've
actually been
it.
Underperforming the broader market. What about Target? Target's actually been an outperformer.
Open-minded to that, but they've owned it in the past and sold it for a profit, paid taxes, and that's kind of a bitter name. But I'm open to it. I just not today.
That's interesting because I feel as if a lot of guests come on and they're all avoiding the consumer discretionary stocks because they're like, I can't bet on the consumer. Maybe the Costco's or TJX's, but not a lot else. But you actually think that the consumer has hit bottom and is going to improve.
There's a pretty good gear ratio there between consumer confidence, it's just the numbers you get from the conference board, or maybe even University of Michigan conference. There's a really high correlation between that and the performance of these stocks. And you hit rock bottom. There's only one way for it to go, which is up. So you gotta look for those stocks and when to buy them. Maybe it's Abercrombie or whatever, but we're actively shopping. What
would you avoid here?
We're just still avoiding the oil stocks for the most part. We're avoiding the down chemicals, the petrochemical companies as well. The UAE leaving OPEC, I think, is a material event, and eventually you're going to get to this point where, prices will go below $70. I think they might go much lower than people expect. So I'm like a weirdo when it comes to the inflation outlook. I mean, everybody's looking for, high sticky inflation and the Fed to raise interest rates. I don't see any rate hikes this year. Core drivers of inflation are all trending lower, not all, but the important ones. Housing costs and wages have been sort of decelerating here. So core inflation's going to, sort of peter out. I don't see a rate hike, and if anything, I guess the next move for me would be a rate cut.
But not because the economy is too weak.
No, not at all. I mean, it could be, the jobs market, by the time we get there, 6, 8, 12 months from now, might be weak enough for the Fed to act. But I really think it's about inflation generally. They know that the Fed funds rate is now higher. It's restrictive, more restrictive than it necessarily needs to be. So in sort of an economy that's clicking along, I think they'd be willing to cut.
Interesting. All right. I was just taking a look. You have an S&P 500 price target of 78.40. So not the most bullish I've heard, but higher from here.
Yeah.
What's the biggest reason you're optimistic from here?
Well, we're in double-digit earnings growth. It could definitely end tomorrow, but until we get some more sort of signal that it is, I think you stay with it. That's earnings growth is everything. Estimate revisions probably going to be higher coming out of Q2 earnings season. There are some hiccups in the near term. The reason why I don't have a higher price target, you're going into the midterm elections, that tends to bring out a lot of realized volatility that's unhelpful for multiples. So not looking for multiples to go any higher, but you can get there on earnings growth. And so that's kind of where I came up with that.
And that's all assuming that we get some sort of resolution between the U.S. and Iran, that oil prices are going to come much lower, that inflation's not going to be sticky, that the market can move higher. And when do we see this resolution?
I don't know. So you keep all these balls in the air, all these directional kind of cues, and a lot of them fall, right? And we just toss things away all the time. That's my view now, but it's like a rolling evolution, with everybody in this business. And so our expectation is that it gets resolved sometime within the next month or so. Okay,
so if our viewers, the everyday retail investor, sees another day like yesterday, where we actually closed well off the lows of the day, but sort of a sea of red, what's your message to them? Do they stay patient? Do they buy any dip? Do they get more defensive, knowing that there could be, some volatility down the road?
Yeah, I would say if you're buying individual positions, I think tech could be added here. And if you're buying ETFs, like Solvay, whatever, XLK or whatever you're owning, that's fine too. I guess my big message, the message that I had from my mentor when I was in my 30s, which was avoid leverage. He told me leverage is a killer and hubris is a killer. And when you get the two of them together, you're in trouble. And so when we had all that leverage that you could see in SK Hynix and Samsung and South Korea and the Kospi, that was the pain trade. Everybody's sitting on one side of the boat, and you got to go the other way. You knew eventually it was going to crack, and that unwind has already happened largely. And so I think it's okay to come here after a 20% pullback. I think it's okay.
So no levered ETFs for you? No 2 times SK Hynix ETFs? No, you don't need it.
You really don't. You just go to Las Vegas if that's what you're looking for. And if you're trying to make money, just stay away from leverage.
Okay. Yeah. All right. I think it's a great time to pivot to our rapid fire game of this or that. You've played with us before. Yeah. Quick questions, quick answers. Are you ready?
Can I say no? Yeah, I'm ready.
All right, here we go. Right. You can say no, but you won't have any fun then. Here we go. Buy any dip or wait for a bigger pullback?
Buy any dip.
Flight to safety or stay invested?
Stay invested.
Defense stocks or energy stocks?
Defense.
Alphabet or Amazon?
Alphabet.
Broadcom or NVIDIA?
Broadcom.
Semiconductors or hyperscalers?
Hyperscalers.
Cybersecurity or AI infrastructure?
Cybersecurity.
CrowdStrike or Palo Alto? Both of your picks.
CrowdStrike.
AI spending slowdown, overblown or real risk?
Overblown. I think we've been on bubble watch far too long for 2 years. There are some things out there, but most of the things that I've seen are anecdotal.
Is AI a bubble, yes or no?
No.
Bigger risk, China catching up on AI or hyperscaler CapEx cuts?
The former, China catching up on AI.
Memory cycle peaking or just getting started?
In the process of peaking.
One memory stock you would buy here,
It would have to be Micron.
but you're not buying it.
We own it. And yeah, not at these levels. We want it to be oversold when we're adding something. It's just not there.
SK Hynix IPO, opportunity or overhyped?
Opportunity,
NASDAQ listing boom, bullish signal or warning sign?
bullish signal.
Equal weight S&P or mega cap tech?
Mega cap tech.
Highest conviction pick for the second half of the year?
Lumentum.
One word to describe this market.
Strong. And I'd say earnings growth, extra strong. This is an amazing period, and it's a great time to be involved. You got to stay involved, though. You got to make sure that you know what's going on at all times. But yeah, 22% earnings growth expectations, 28% in Q1. That's boom period.
And
So
just
enjoy
finally,
it.
S&P 500 price target by year end.
78.50, 78.40.
We'll leave it there. That's Andrew Graham, Managing Partner, Jackson Square Capital. Thank you so much. Really appreciate it.
Thank you.
Are you glad you said yes?
Yeah, I'm glad I said that.
If you enjoyed this Street Talk, check out our full interview with Victoria Fernandez. She's actually trimming her tech winners right now and explains the name she's rotating into.